Hello.
Hey, Mike, how are you?
I'm good. How about you?
I'm good. I'm good. Just lots of balls in the air today between CPI this morning and then just watching lumber, the beatdown continue here.
Wow. What a beatdown.
Well, we talked about the shorts would get punched in the face to the upside, and then supply constraint rally, bear market rally. As soon as you stopped and the momentum stalled, you'd punch the longs in the equally in the face back to the downside, and here we are.
Yeah, this one has been interesting to me in that there's just no stopping it. It is just,
No, I always, unfortunately, lumber, my rule of thumb here is never get into a bar fight with anybody missing teeth or that has cauliflower ears. And lumber's the commodity that's missing teeth and has cauliflower ears. It likes to punch people in the face. So here we are.
and you know, I'm sitting here kind of watching it day in and day out, and um, that the algo or some of the non-traditional lumber traders I feel like they're in there and they are just pushing it until it doesn't push anymore, or until it pushes back, I should say.
Yeah, no, absolutely. And the answer is, again, if the industry doesn't want to use it as it's intended for, and the algo smells blood and can trade the volatility, you're going to push until somebody pushes back. And here we are. I mean, it's just I saw your take on LinkedIn, kind of with today's show. What is this? 8 consecutive days now of just
Today,
just
yeah, today is the 8th.
yeah. We topped out at 5:30, and it's just amazing how it's gotten annihilated since. And let's jump. Are we ready to go? Are we
Let's do it. Yeah,
go
let's do
time?
it.
Hello, everybody. Let me go here. All right. So happy Valentine's Day to everybody. And Kip, today's his birthday. So happy birthday, Kip.
Happy birthday,
I'm
Kip.
not going to
All
say how
right.
old he is, but happy birthday.
He's definitely not old enough to know better yet because he's
Yeah,
still in
right.
lumber.
Right, right. So I think the big thing, again, starting more broad-based and then funneling into lumber, the big disconnect. I mean, equities have obviously seen nice appreciation through January into February now, with the Dow and the S&P leading the charge to the upside, the Nasdaq and kind of getting dragged behind. And we've seen a bigger concentration of layoffs coming out of the Nasdaq technology sector. So I think the easy assessment here is this is the burn rate here. This is a very capital intensive area, and money's no longer free. So, as business kind of slumps off, the free money, just isn't there. So that's kind of a good explanation why NASDAQ is dragging behind other equities. The other big takeaway is since the FOMC announcement, and since we've had different Fed governors speak last week, the big takeaway is that 10-year, 30-year have been moving in the other direction, in direction not so friendly to housing. And it's pretty interesting. I finally saw this when I resized this chart. It's pretty interesting. Look at lumber and interest rates here. Kind of a very similar topping out pattern where 10-year topped out in the four or bottomed out in the 3.45 area. That also coincided with the highs in lumber. And as interest rates have pulled back, you've had this kind of mimicking the sell-off in rates here, or the increase in rates going higher with the sell-off in lumber prices. So cause and effect I think at the very least, when you look at this um, lumber rally, it's supply constraint driven, and the demand kind of got pushed into the market. You had some initial short covering, you had a round of buying, but there just isn't the demand, organic demand, to support those higher numbers yet. That doesn't mean that doesn't happen later this year, but it's just not there right now. And so, the other thing that stands out again, this is from Goldman Sachs, and you look at the call volume. Again, any news that seemingly comes out with equities, regardless of whether it's bearish or not, the market's mindset, equities mindset right now is you've got a pretty big call number where people are pretty bullish with equities right now. Where people don't think the Fed is going to follow through with what they're saying, regardless of whatever the economic numbers that come out suggest. Equities seem to have their blinders on, and the bias is definitely getting more bullish day in and day out.
Well, I think that the market likes what they're hearing from these companies. We are going to trim staff. We are going to tighten up. We understand that we're probably not in a growth stage, so we're going to try to maintain margin, and if anything, even raise margin.
Well, and not only that, I think the forward-looking guidance. Look, we're going to do the initial cost cutting / overhead, but the forward-looking guidance is, the end of November, December. You were kind of building in this worst-case scenario, and now, as we've come out of January into February, you're seeing a lot of revisions, whether it's housing. And a lot of different sectors where it's not that worst case scenario, that it's not as bad as anticipated. That, I think Goldman came out, David Solomon was speaking today and basically said, there's a higher probability of that shallow recession, that soft landing scenario than there was a month ago. So, the market likes that.
I want to show something here. This is an article I read this morning on Bloomberg, and it's new cars are only for the rich. And two things we just talked about are in this article. The first being interest rates have made cars more expensive. And we've been talking about that when you show the mortgage rates and, how much house a payment buys. And, of course, the cars are the same way. You don't walk in and say, oh, I can afford a $70,000 car. You say, I can afford a $1,200 a month payment.
Yeah.
So obviously payments have gone up to quite high levels, but they also talk in here about the supply side from the manufacturers. There's no incentive for them to really make more supply because their margins are so good.
Yeah.
So right here, this is where it says manufacturers are reaping the benefits of selling fewer but more expensive cars. They sold 8% less cars, but the gross profit at Ford rose 4.4%.
Yeah, and so the other part of this, as much as we want to criticize, and we saw this with the oil earnings, how greedy oil companies, record high profits, blah blah blah. But if you're truly forecasting a recession or the probability of a recession, what's the incentive to increase production at this point? Anybody, the last time I checked, all these companies don't have .org at the end of their names. They're in business to churn a profit. They're publicly traded. They answer to their shareholders. And at the end of the day, let's not kid ourselves. You want a higher share price. You want a higher return to your shareholders. And that's what they're trying to accomplish right now. And so the idea you're going to see more production come on anywhere, if there is economic uncertainty and the fear of a recession, and however you want to define a recession, but what's the incentive? Why are you just going to flood the market with more supply at this point? It doesn't, from running a business 101 standpoint, it doesn't make a lot of sense.
Oh, agreed.
So let's go back here. So the other one, we talked about the US dollar last week. You've had some stabilization, but as the dollar, kind of peaked out and then it started to trend back slightly to the downside, you've got a slight upward bias in commodities with the exception of lumber, but wheat, copper, gold, crude oil, and you'll see it here. 5-day returns, wheat's up 6%, lean hog, soybean meal, Goldman Sachs commodity index, crude oil, Brent crude oil. So all these markets have been a beneficiary. Again, dollar denominated commodities are the beneficiary of a weaker dollar. So I don't think that that's just a casual coincidence here, and that the dollar definitely influences commodity fund buying, fundamental perspective in all of these commodities above and beyond just geopolitical events.
And the other thing I look at here, though, is nothing's running away right now. These are modest gains compared to,
and these are modest gains. And if you were to go back and look at this year to date, it would look a lot different, where you're just recouping losses from January. So it's not like indication, like life is good again. It's just you're seeing a nice bounce over the last couple of weeks in a lot of physical commodities because of the dollar stopped. We had been kind of moving back up. We're moving back down a little bit now. And when you look at the big losers here, unfortunately, lumber, and this is probably off another close to 15% today. But you just have continued ugliness in lumber here.
We don't know how to sit in the middle of this thing, do we? We're either on the top or the
we're either
bottom.
at the literally 2 weeks ago we were at the top of the gainers, and now we're back to the bottom. So the other one I'll point out, and I thought this was interesting. I know people have kind of been waiting. Is gold some kind of flight to quality? And the answer is, so far, when you look at gold 52-week return, it's still down sub 2%. So you've had big appreciation in Q4 into the beginning of Q1 of this year. Whether gold, I guess beauty is in the eye of the beholder. And the answer is, yeah, gold's had a nice bounce back, but it's just recouping losses from last June through September, October. So, as much as I want to say there's this flight to quality, obviously, to gold. Gold has gone up as of late, but I don't think if you believe in this, then maybe. But this is depending on what time frame you go back to. This 5.6%. If you look at the last 52 weeks, this is actually still down 2%. So.
I'm not a biggest believer in gold anymore. I think gold used to be the easy inflation hedge. But as we have more sophisticated products out there, I think there's other. I think that's.
Well, I think with gold, it's probably the hard asset of gold, like physically owning gold in a storage facility, more so than gold ETFs. And again, I have people that want long exposure to gold, and I have no problem with it. But it's one of those things where, just like anything else, you get the two-sided volatility. So interest rates, 10 years, have ticked back up a week ago. A week ago today, we were 3.65. Today, we're up to 3.77. So trending in the wrong direction. 30-year, again, 30-year fixed, same metrics. You're creeping back up to the 7% area. Obviously, if you have better credit, different silos have better, but this is legitimately up close to a half a basis point from the low water mark we were just at 2.5, 3 weeks ago. So, you're trending in the wrong direction again from a housing standpoint.
Yep.
And then when we look at Fed funds curve, and you look at some of the, the jobs number that came out last, or a week and a half ago, you look at CPI today, which we'll cover. I don't see the scenario where the Fed takes their foot off the interest rate gas. And so this kind of projects topping out into Q1. This is your futures suggesting something versus the actual, what the actual Fed is telling people. There's a big disparity between the two right now. We went over this last week. I left this in here just to show, again, as rates creep back up, we were just at that 6% area. You're back closer to 6.5%. So, again, just look at, if you were to be at 5.22% versus basically a handle higher, there's a pretty substantial difference in that monthly payment. And more importantly, there's, again, 5 million people that get priced out of buying a home. So this is critical. If we're going to stabilize and grow housing demand, you really need interest rates to cooperate here. And again, that probably falls into the back half of 2023 being more organically friendly to single family than right now, because right now I think business is better than what the home builders were forecasting, but that's coming off of a pretty apocalyptic November, December, where you're not zero. I think the metrics improved in January into February, but by no means is, when you go back to lumber pricing or just overall market structure, demand's not ready to carry the flag here. This is still all about supply constraints to get higher prices. So CPI, I think the CPI comes in higher than expected, 6.4%, and so you're still up. The year-over-year metric is still the fourth highest on record. So in recent history, so as much as we know that inflation with goods seems to be moderating, when I look at this report, I look at that PCE. Again, some of the inflationary metrics the Fed looks at, there's still heavy lifting to do here. As much as I'd like to see the counter argument with the actual numbers here, I'm not seeing it where I think the foot is still on the gas as far as interest rates are concerned with Fed funds rate.
So this morning, Fed governor from the Richmond area was on Bloomberg when I was driving in, and he said basically, yeah, we're pleased to see the numbers changing, but you're right, we're not done yet. They have to continue on to hit our targets. And he basically hinted that it's probably going to take longer than expected. They may not have to go as high. Then, it might not be that they need to jack interest rates higher than what people are expecting, but they'll just stay at a higher rate longer.
Right. And so here's the thing. I mean, when you break this down, headline year over year, and this is what everybody fixate, that's the headline number. Inflation is still running at 6.41%. Core year over year is sub 6% now, 5.58. Services, this is the one that I think will continue to increase. This is going to be the most sticky to bring down, where you're not going to claw back wages. You're giving people more money. You're not clawing that back anytime soon. The answer, with the Fed will be people just lose jobs. You're not going to take pay cuts. You're just going to lose jobs at some point. I guess the good news here is goods. Definitely seeing a small moderation. This is well under Fed target as far as year over year, month over month increases. Same thing with food and energy. But I think what you're going to start to see, and you're seeing a lot of, Goldman Sachs, JP Morgan, some of the big analysts out there, this shift of inflation from goods into services, and this is going to prove to be much more sticky than goods inflation moving forward. And again, you see this in so shipping container inflation. This is a big positive. Look at, we basically are back to the inflation has been taken out of shipping containers from China, which is a positive thing. You're back to pre-pandemic type levels now, which is a big positive. But again, this is when you look at wage growth versus, you got to see this shrink. I mean, you got to see this converge, where you can't have people continue to be outpaced with inflation on goods and services versus their wage growth. To me, this is, this has to narrow dramatically. You've got to see the convergence here to say all is well. Getting into housing now, I think this is a nice green shoot in that mortgage applications are definitely showing signs of bottoming. And this is from Leonard Kiefer from MBA, which is a good thing to watch. So this is encouraging that maybe we're putting in a bottom with mortgage applications, and we start to trend, again, contingent upon interest rates moderating, you start to see more mortgage applications. And again, you'd like to see that more so in people refinancing. You want to see this obviously with new home sales. You want to see signs of glimmer of hope that single family is starting to kind of show signs of a bottom. That this is one of the things, this is one of those things to watch as a sign of that. So later this week, Thursday, we have starts and permits. Housing starts are the upper column here. So previous starts are 1.382 million. Consensus is slightly lower. I think, and this would make sense that from a housing standpoint, if housing was better in January, then this permits number, I think the starts number is kind of, so it is what it is. The permits number, you should see an increase. So previous is 1.337, consensus is higher, forecast is even higher. I think this will be a good indicator as far as, did builders actually see more business than forecast in January? You should see it in these permit numbers. Again, that's a leading indicator versus starts. Jumping into
What
lumber.
day is that? I'm sorry. What day was that on?
This coming Thursday.
Got it. Okay.
So we have Thursday, we have PPI, which is producer price inflation, and then housing starts. So another big day for the markets. Okay, this is the monthly continuation on lumber. Put in the high, I think the thing that jumps out here is January expired at 344. Is there any chance that we go fill that January gap? We know lumber likes to fill gaps. We filled, on the way to the upside, we filled the November and September expiration gaps. So can we go fill this January gap? We're basically down to a low of 403.80 today. This is your 62% retracement area on the weekly. Actually, it was 412. So can we go fill this gap or get within 2%, 5% of that gap? And that's the $1 million question now.
And, I guess I'm kind of looking at the way it expired. So the beginning of December, it just leaked out the entire way.
Yeah.
So we're kind of in that same time frame with respect to expiration of the contract. And we're just leaking. Like there's no bid in the market.
No, and then this is the tough part. Do these numbers, after being down here and legitimately having cash trade sub 350, sub 330, I mean, cash probably got down into that 325, 320 area for the masses. Okay, January went off at 344. You go from January expiration at 344 on a continuation basis, you pop up to 530. Does a 50, 62%, so the answer to me is at least, and you'll see this now, and I'll just kind of jump ahead. We'll come back to these, but from a basis standpoint, we talked about this on the 17th. We got out to that $80. And again, basis is just cash minus futures. So at one point, futures we know traded $80 to $100 over physical cash. Fast forward to this morning, you have print being held up now where, look at this. I mean, you went from 80 futures, 80 to 100 over to go back here. Today you have futures. And again, this is print. It doesn't mean you believe in print, but futures is at a substantial discount to where print is, where the mills are ask price is right now. So again, I'd have a hard time telling somebody that they should be selling futures here at this big of a discount to cash. Now, legitimately, and I'd love to know what people think. I mean, we're hearing stories of basis wood being unwound with some of the secondaries in that 400 to 415 area on a Western SPF 2x4 basis and having limited success moving off that wood. But the reality is March is probably a pretty accurate indicator right now of where the secondary market is in physical cash. And again, beauty's in the eye of the beholder. Do these numbers mean anything? Do these numbers float the boat for anybody to start to accumulate futures? Is there value in cash or futures at these numbers? And the difficulty going back again to the weekly chart. Well, you know where you just came from. Is this reality, or are we going to reset at some higher base now? And if you're a believer that we've seen the lows, then we should reset. Probably my guess is in this 400 to 375 area would be good enough in March. And here's the March daily. Bollinger Band low is at 394.
Oh, hang on just a sec. I want to talk about a conversation I had with someone who did put a basis trade on at that, fairly wide basis. And they're like, well, what do we do now? And this is the strategy part. Buy what's cheap, sell what's expensive. So, previously when the basis was a negative 80, you bought cash and you sold futures. So then fast forward to today, the futures has come off. They have money in their basis trade. I'm like, well, now you do the same thing. Buy what's cheap, sell what's expensive. Buy back your futures, but then it lends to the conversation you just had. Is this value? So all of a sudden you've bought this cash market and you put your futures profit onto that, into that, which lowers the price, maybe it makes sense just to hold the cash.
Yeah,
Um,
yeah. And again, I'll add to that, Mike. And I have people, well, I'm frozen in the cash. Well, then you've got to, okay, do you want to speculate and come out of the futures? The other option is here's the March. I mean, here's that. And from May moving forward, I'm going to try to talk about the mini contract because I think by the time you get through March expiration, this is going to have at least 50%, if not greater, of the open interest versus the legacy May. So we'll start to kind of fixate going forward, just gradually start to introduce the mini charts versus the legacy charts, or maybe a combination of the two, just
Yep.
to educate people. But when you look at March, May, the spread, that spread got out to $27, $28 yesterday. So, my answer would be, look, I'm frozen in the cash. I can't come out of the cash because I can't find a bid. Um, I'd like to come out of my futures, but that's speculation. So at the very least, what you could do, you might as well roll your March short into May and pick up the premium and get paid to do it. At -20, -25, do I need to be short March at -20, 25 under May? The answer is I probably take my money out of the March and just move it into May and pick up the premium there, and
But
and then wait for that convergence.
so my friend who did just that. They rolled their futures into May, and I said, "Well, that's great. You're right. What you said, you're picking up a $27 bill, except what basis trading tells you: buy what's cheap, sell what's expensive. Cash theoretically is $50 over futures.
Right.
Cash is expensive. Sell it. Buy back your futures, or buy back your futures and be a little specky on your cash.
Yeah, and again, I mean, to each his own, and this is why I hate. Obviously, Alex and I are not big fans of the blanket approach. And this all, are you buying mill direct? Who are you selling to? Can you put the wood on the ground? The second you get a rolling card, you have to have a desto on it. Is it going into a reload with 9 million other people with the same basis trade on? To each his own. And that's why I think, I know Brian at Brian McFarland kind of referenced this Taltree, you got to account for cost to carry. When's the wood going to ship? And that there's no blanket answer for anybody doing a basis trade. It's highly unique based upon species, items. Are you putting the wood on the ground? You're not putting the wood on the ground. I'm buying mill direct. I'm buying from secondaries. Who am I selling it to? And all these things have to get factored into how you basis trade. We can talk about generic basic concepts, and that's the idea of the show, but the actual application of these concepts is it has to be very specified to who you are and how you use this.
Now, one thing we hadn't talked about yet, maybe you wanted to talk about this, we're actually in a forward price market right now.
Yep.
I don't know, were you going to bring that up?
Yeah, let me. So what Mike is saying is that you've got you stair step up in futures, but you have, instead of cash being down here, you've got cash up here. Is
right,
that what you're?
Yeah, you're better served if you are sitting here today. For whatever reason, you have exposure to lumber prices in May, June, July. Do you buy cash? How do you protect yourself, right? We've been given, now you're given the opportunity where you can buy the futures and let the futures be your protection.
Yeah,
versus buying whole cash.
You know what? I might have. Let me see if I might. This might be a better representation. Here's basis. So this was the opportunity. Again, basis is always cash minus futures. So down here, cash was the buy, futures was the sell. As you go back here, then cash becomes the sell, futures becomes the buy. And what we're seeing with jobbers now is just this, that this is the opportunity as you sell short the cash jobs. And you see this with a lot of the multifamily jobbers where, look, we can go sell this job, but we don't necessarily like the risk of waiting 3 months, 6 months, 9 months out. There's speculation in saying that cash is going to be at these levels or lower. So the answer is you've got the opportunity to buy futures along the curve, where I can buy March today, literally at the last trade 405.40. May got down to 425.50. And then you can even look at mini July futures would equate to like a 445 legacy. So, you could even buy July unlimited volume here, but this is the opportunity to short cash and go buy the futures against it, especially as you go out along that curve out in time, 3, 6, 9 months out.
Yeah, and this is the important to understand the structure of the market and what you're in.
There was just seasonality wise. So you've got, if the last 3 to 5 years, you should have a slight bump up into the next couple of weeks before the next leg down. If you're not a believer in the last 3 to 5 years, then the old adage is today's Valentine's Day. The old saying, don't fall in love with your longs into Valentine's Day. So, are we going to see a more seasonal pre the last 3 years, the last 5 years, pre 2018, where the market typically would top out into literally Valentine's Day, the third week of February? You'd see the highs for the year. And then you would kind of slump off into more of the seasonal lows here into the kind of third week of June. Or you're a believer in the last 3 to 5 years and that there is more business ahead for spring. Spring's going to be a surprise, and there's more upside potential as we get through kind of March expiration, and then you get that push into May expiration. So again, this is the art versus the science of trading, where, do the last 2 years, 3 years mean anything? Do you ignore that and look at the last 7, 10, 15-year averages? Again, this is what makes a market, in that for everybody that thinks it's a buy, there's obviously somebody that thinks it's a sell, and that's the beauty of trading. But, when you look at, again, if I want to ignore the last 2 years, okay, well, this was as of January. So we got up to $500 the end of January, beginning of February. If you throw out the last 2 years and just look at 16, 17, 17, 18, 18, 19, the answer is you got too overextended, and you're just seeing a reversion at $400 now. You're just seeing a reversion back to kind of mean type pricing, throwing out the last 2 years.
I still think we're shifted a little back. I think that.
Yeah, and so then again, here's March expirations. Again, last 2 years, you're in the stratosphere here. Take out the last 2 years, and okay, we were just up at 509 a week ago. Back to reality here, but you're back to a more seasonal historical reality.
Yep.
Curve. Here's the May basis. You went from futures trading 84 over to 30 over, and this is actually increased. And again, this is just based upon print. I don't think anybody's going to be a believer that reality's print tonight, but that's what we're looking at. And then from an open interest standpoint, we're sub 2,000 now. 2 weeks ago, we were up at 2,300. We know the high water mark, we were up at 3,200. So we're sub 2,000 now. You continue to beat people out of, bludgeon people out of this market. Open interest in the mini continues to climb at a slower pace. And so the frustrating part in all of this analysis, Mike, as you know, we keep waiting for commitment of traders. It would go a long way to see. We haven't had one since January 24th. Still have major, they had a cyber event, and they still can't validate the information they're getting from the clearinghouses. So we still don't have an updated CFTC commitment of traders report, and there's no timetable as to when we'll get an accurate read. So what I'd like to see personally is, okay, we know that the commodity fund shorts got annihilated what was the low watermark they came down to. We know on this reversal, the commodity funds chase the momentum to the upside. They're getting bludgeoned out of this market to the downside. For me right now, I want to know, are there new commodity fund shorts coming back into this market now? That's what I'd love to know. Are the funds back into this, or have the funds that just simply abandoned ship on both sides? And unfortunately, it's a guessing game until we get an updated CFTC report.
Well, I tell you what, when I look at this whole thing, I think the two most important data points, looking at January expiration, we can get down there. Like, there's room to the downside. There's no doubt about that.
I'll go back to that chart. Again, this is the weekly chart that Mike's referring to. Here's January expiration at 344. Here's your current market. We've gotten as low now as 403 even today.
So there's room to the downside. History has proven that, recent history. But on the flip side, your basis opportunity has flipped to a forward price opportunity. And you should do something with that. Buy what's cheap, sell what's expensive, always. And futures is cheap. Cash theoretically is expensive. If you have the liquidity to exit your basis trade, you're exiting with a fine profit.
And again, as much as we'd like you to trade futures from a basis standpoint, you at least have to understand the concept of basis and what's overvalued, what's undervalued. And I think that should, again, as much as I'd like to see it applied to the futures market, it at least should be applied to your business as far as running a business where, if I'm buying cash today, it's not from a sawmill. If I have to buy, I get it, but you're going to do much better in the secondary markets trying to bleed out of wood versus supporting the mills at some ridiculous ask. You've got this game of chicken now where we'll see how real mills order files are. With the mills still being 460 plus, something tells me they're not moving a lot of wood outside of their contract wood. And we'll see how real those order files are. And if they are real, then futures will bottom sooner rather than later, and you'll get that convergence at some point back to the upside. But if futures are truly a leading indicator and those order files aren't real, or there's not follow through with more permanent supply curtailments, because that was the catalyst, that was the driver to the upside. So keep the shutdowns coming, because this, as much as we wanted to believe that demand is improving or going to improve, so far the proof is the demand is still not the savior. So it's got to be supply constraint driven. So if you're a sawmill, keep it coming. And it doesn't necessarily have to keep coming out of BC. You can come out of other areas too. It's not just a BC problem.
Great point about the supply is what's driving the market. Agree with that 100%. Also agree with, like you said, we'd love for everyone to be involved in the futures market. But if you're not involved and you're buying in the cash market and you hear, or buying or selling in the cash market, and you hear a ridiculously low number on some cash price and you call BS on it, it might not be wrong. Someone coming out of a basis trade needs to exit, and they will go to the market. It's invisible, but there's always a bid and there's always an ask in the market. And when the market's moving higher, we trade on the ask. We trade at basically the middle level. When the market's moving lower, we trade on the bid, and you don't know who's hitting those bids.
Yeah, absolutely. Absolutely.
So if you want to buy the least expensive wood in the market today, it's basis traded wood, I'm sure.
And Mike, I forgot to, and I don't even have the slide here. This is how bad I am at advertising. Alex and I are having a risk management strategy. It's going to be in Nashville this year. It's the end of April. It's going to be a day and a half event in Nashville. We figured a destination location would be a little bit more attractive than going to Kansas City. Not that I love Kansas City. They won the Super Bowl, but this one will be end of April in Nashville. We'll forward on the details. I'll have the details next week, but this is going to be geared more toward the intermediate to advanced futures trader, where we're going to get into technical analysis. We're going to get much more detailed information on actual basis trades, forward inverted structures, option concepts. It's going to be kind of futures at the probably 300 plus level instead of coming in futures 101. So
Cool.
they
That's
just kind
excellent.
of throw that out there.
Perfect. And then, of course, you're speaking at the Montreal Wood Convention.
Yeah, that'll be. I think it'll be a good. Alex and I are speaking in Montreal along with the CME, and that'll be a good. From a timing standpoint, you'll basically be on the precipice of the truck contract being the contract at that point, and we'll have some pretty good numbers at that point on where we're at. From a truck open interest volume standpoint. And again, just the basic foundations of why you would use this from a risk management standpoint. So honored to speak there and can't wait.
Perfect. All right. Thanks, everyone. It's 12:40, so we've burned up your 40 minutes of your time. Any questions, send us email. We'd love to answer them. And if nothing else, we'll see you guys next week.
Yeah, I appreciate it. Thank you, everybody. Thanks, Mike.